Hey traders, welcome back to the weekly Forex Forecast. Last week we had this move in the dollar index, and this move was so strong to the downside, we've only seen this happen 67 times since 1971. And that's when most generic data sets begin. And in today's video, I'm going to show you why, historically speaking, this most likely signals further upside in the dollar over the next 6 months. Something very important that you have to pay attention to for the dollar pairs next week is the economic calendar. And you can look down this week. There isn't actually anything coming out this week that is going to affect the dollar coming up. However, if we skip ahead 1 week, you can see that we do have FOMC on the 26th. So not next week, but the week after. Now, when you put this into perspective, one, when you have such a strong move in the dollar like we saw, very often what follows is a correction or at least a sideways market lacking any real direction. And if you take into account the fact we also have FOMC coming up, not next week, but the week after, very often you see currencies ranging into these events as well. So there's two reasons here now: the strength of the move last week in the dollar and FOMC on Wednesday the 26th that point towards a ranging US dollar for the next week and a half. Okay, so let's have a look at the scores for the coming week. And there were some really good signals last week from the scorecards. And I've said this to you guys before, these are leading pieces of data that are used, and therefore they do tend to lead markets. And you can see last week, the pound and the Swiss franc were highlighted as good plays. And the Japanese yen had bottomed in the scorecards. And very often this precedes bottoms in the market. And as you can see, the Japanese yen has actually strengthened quite significantly. And that was a good signal not to take Japanese yen shorts last week and instead expect a potential bottom in the Japanese yen. Now, coming into this week, one of the best ideas from last week, Swiss franc longs, is now the number one. It has taken the place of the pound, and Swiss franc long plays last week were fantastic plays. So coming into this week, Swiss franc long plays are my number one theme heading into this week's trading. And I also like pound pairs to the upside as well. And I'm going to be primarily looking to pair those versus the US dollar, which is now the best short in the scorecards. Also the New Zealand dollar, the Australian dollar, and also the Canadian dollar, which decreased its score by -2, setting it up as a good opportunity to look for shorts in this market this week. So I'm going to be primarily looking for US dollar, Swiss franc, New Zealand franc to the downside, Aussie franc to the downside, CAD franc to the downside. But I'm also going to be looking at pound dollar to the upside, pound New Zealand to the upside, pound Aussie to the upside, and also pound CAD to the upside next week. Okay, so let's have a look at the individual currencies, starting with the dollar index. And just bear in mind, I want to spend a little bit of extra time on the dollar, and we're going to blast through the rest of these quicker this week. Then we're going to move on to the best markets I'm looking to trade. But it's very, very important because this affects the markets going into next week, especially some of these dollar pairs that I'm going to be looking at trading. Now, the first thing to note, very, very first thing before we look at the historical signals of that move last week, is that I can either be short US dollars next week or do nothing. Buying US dollars next week is not an option for me because the scorecard is projecting a -2, which is bearish for the dollar. So going into next week, I do favor dollar shorts, but what I want to show you is how this move we got last week historically signals further upside in all probability in the dollar over the next 6 months. Okay, so as I said to you before, this move down was so strong last week. We've only seen it 67 times since most data sets start, which is back at 1970s, in fact, in this case, 1971. And so what I've done is I've gone back and I've put down all the weeks in which we had a sell-off, which is comparable to the sell-off that we saw this week. And as you can see, there's only 67 out of all of these weeks going back to 1971. Now, to try and get any idea or handle on the significance of last week, we need to actually put in a couple of filters. So I just want to add in a couple of broad generic filters so we can actually drill down a little bit into what's giving signal and what potentially isn't giving any signal and is really just noise. So the first thing I'm going to do is just going to add a very accepted method of defining whether something is bullish or bearish, and that is the 200 moving average. Now, there are better ways to establish a trend, but because it's a generally accepted way of assessing whether something is bullish or bearish, we're going to start off by adding in the 200 moving average to the dollar index. Okay, so now we've added in the 200 moving average into the weekly chart. You can see we are currently above the 200 moving average. We've been rallying in the dollar and we are correcting and we are above the 200 moving average. So we can define the dollar as currently being bullish with a 2 standard deviation close to the downside. So if we go back historically and we filter out any of the previous dollar trends or conditions which are not the same as what we currently have, in other words, we filter out the sell-offs below the 200 moving average, we can see that we're left with only 22 out of 67. So only 22 times historically has the dollar index closed down with 2 standard deviation week whilst it's been above its 200 moving average. And you can see we first start getting those signals back in the 80s. So this was when we had that other strong inflationary regime taking hold in the 80s and with Volcker. And of course it is slightly different this time around because of the debt load. But you can see we had the burst of inflation. And in fact, I'm going to show you why I do think this period over here in 81 is more comparable to what we've got now. And I do think the outcome could be similar, but I'll show you that in a bit. But you can see this was back during the 80s. We had the high inflation, we had the dollar rally, it peaked, and then we had the dollar selling off after inflation had peaked. And what do we see over here? We see that we get these 2 standard deviation sell-offs in the dollar, 1, 2, and then 3. And what happens shortly afterwards? We form a near-term bottom and we start to rally. So each of these 3 sell-offs in the dollar, because going back here, it's below the 200, we don't have any data for this. So the first ones we see here are back in the 80s. And you can see each time, 1, 2, 3, 4, there's another sell-off. 5, there's another 2 standard deviation close above the 200 moving average, you know, when the dollar is trending higher. And we have another one over here, which sells off, and then we rally into the highs. And then we get over here, 1, 2, 3, 4, 5, 6, 7, which close below. So very similar to what we had this week, above the 200 moving average. But all of these 7 fail to make new highs. And what happened here? This was the Plaza Accord. This was where the dollar got so strong that there was a meeting, you know, between the Federal Reserve, the Bank of Japan, etc., all of these major players to weaken the dollar. So it was major central bank intervention, which not only reversed the dollar, but it was what actually caused these sell-offs here, because these all came after the Plaza Accord was started to be put into place. And so what we see here is going back in the 80s when we had a similar situation with a bout of inflation and we got these 2 standard deviation closes. In each of these cases, they were followed by new highs, and these were simply corrections in a larger uptrend. And the only ones which failed back during this period, so we had 6 of them, 6 of exactly the same signals which resulted in new highs in the dollar, and then we had 7 which didn't. And you may say, well, 7 is more than 6, but there's a difference here. The nuance is this was after major central bank intervention, which, remember, we haven't actually had yet. So this was the first period where we had this kind of signal. It was in the inflationary period of the 80s. Now, the next time we get these signals is in 98 to 2000. So this is the run-up to the dot-com bubble. So as we're running up, and then, of course, the bubble pops. And what you can see is, again, we have 1, 2, 3, 4 times historically during this period where we had the same 2 standard deviation close, so something which really only happens less than 5% of the time. And in each case, it was followed by new highs in the dollar, despite the fact, look at this huge sell-off here. It kept above the 200, and we did see new highs in the dollar, new highs in the dollar, new highs in the dollar, until here. So in this period, whereas in the 80s we had 6 successful signals where we reached new highs. Then we got the intervention with the Plaza Accord, and then of course you had 7 which didn't work, but in between those was the Plaza Accord. as is the case over here where you have the run up and each of these is a signal for new highs or is followed by new highs in the dollar. And the one which fails and actually breaks down below is after we get, the central bank intervention, because the recession has already taken place. Exactly the same in the 80s, we saw the recession, and then after the recession, we start to see the dollar falling. Same in 2001, you can see in the lead up to a recession, the dollar is rallying. These signals are followed by new highs. And then, once we get the recession, we start to see the dollar selling off as we see stimulus coming back into the economy. The next time we see this signal where we get this kind of sell-off, but whilst we're getting strength in the dollar and it's above the 200 moving average, is in December of 08. And of course, this is after the 2008 financial crisis. We see the dollar rally, then we get this, and what happens? We see the dollar actually rallying to new highs. However, it's important to note that this sell-off here, this coincided with, of course, the massive stimulus that we saw post-recession. So this is the recession already taking place and the dollar strengthening, and this is post-recession, although in this case it still makes a new high. The next two times we see this is in 2015, 2016, where we get a big run up in the dollar and then we see this correcting as we get that strong close, and we see it correcting as we get the strong close. In both cases, this was just a correction for the dollar to make new highs, and you can see over here we actually had the run up in 2017. So yes, it did take a little bit of time. And again, I point out that next week, I'm not saying it's going to immediately reverse next week. We may actually see a little bit more downside first. But in the bigger picture, we have seen again, when these come in, as the dollar's trending to the upside, we see the dollar making new highs again. And this brings us to the most recent signals where we had the sell-off post-COVID. So we had the crash, then we had the injection of liquidity. And in this case, this was a failure. We did not make new highs. Okay, we made new highs eventually over here, but this did start to make new lows first. This is why this would be considered something which was unsuccessful. It kick-started a down move or a bear market here in the dollar. It didn't immediately rally to new highs. This wasn't a correction for new highs. This was actually a reversal of the market. That's why this is in red here. And of course, the most recent one was on the disinflation trade. So we saw CPI coming out softer, and that was when the dollar peaked. And now we've seen this signal once again over in this area. So to sum up the signal that we actually saw last week, and to put it into perspective, we have seen this 22 times historically since 1971. And in 13 of those cases, the dollar rallied to new highs. And in 9 of them, it actually reversed the dollar and kickstarted a new downtrend. Now, you may be saying to me, well, 13 versus 9 is not very statistically significant, and that is true. But you have to remember, 7 of those came after the Placer Accord. And so we had that massive intervention globally to devalue the dollar. And then we had 7 of them in a row, which kickstarted the big sell-off in the dollar index. And outside of those 7, we only saw this 2 other times actually reverse or be part of a major reversal to the downside in the dollar. That was after the 2001 recession, which marked the peak in the dollar and the new bear market. And the other one was after the COVID recession, again, after we got that liquidity, which marked a new bear market. What this means is, historically speaking, it's fair to say that whenever we've had these signals, especially just before or during a recession, every single time the dollar has made new highs and continued its overall uptrend. The only times that the dollar has reversed is when we've had massive central bank intervention, and that was the Placer Accord after the 2000 dot-com bubble peaked. After 2008, even though 2008 did make new highs, of course, that kickstarted the next few years down in the dollar. And after the COVID recession, when we had the massive injection of liquidity and we saw the dollar start to sell off. So every single time, unless we've had massive central bank intervention to devalue the dollar has actually rallied to new highs after a 2 standard deviation down week in an overall dollar uptrend. So I just want to wrap up the dollar here by saying that I do not have a crystal ball. I do not know, of course, what the future holds for the US dollar. However, I would suggest that the absolute top in the dollar is not yet in, that this is not the start of a new bear market, even if we have some near-term downside. And it's interesting that this is taking place just as we retest the major key area of resistance testing now as support, and at a time when we're probably going to see a correction heading into next week because of the period between FOMC and also the fact that corrections usually follow such sharp moves. And then if we get the Fed raising rates in a week and a half's time, is that going to be the catalyst for this to bottom and start to make a rally towards new highs? So I'm just putting it out there. I'm sure people will have different opinions on this. That's fine. But I think it's very, very interesting, the current setup we have in the US dollar. And I do think it's actually quite similar, although not as extreme perhaps. Maybe we just make one more high, maybe during a recession. But I do think it's similar to this kind of pullback we've seen over here when we had 3 in a row back in the 80s before making new highs in the dollar. Okay, so I just want to wrap up the individual currencies by looking at a couple of these. I'm not going to look at all of them because some of these are just ranging, like the New Zealand, like the Aussie, but some significant points in a couple of these. One, the Swiss franc has reached the 1.17. I did tweet out on January the 1st that I believed the Swiss franc was the currency to watch to the long side, so long Swiss franc as the play into the 1.17. We have now achieved that, and you can see the momentum here. This is likely to continue. Yes, we probably need a pullback because it's so strong, very similar to the dollar sell-off pulling back, but I do think we could even head higher than the 117 in the Swiss franc. Next is the Japanese yen. Now, the Japanese yen did in fact bottom, and we saw huge strength in this after we got that kind of bottoming in the scorecards, where the scorecard said beware of a potential Japanese yen reversal. It's been one of the best shorts ever since the BOJ reaffirmed their yield curve control program. But we got that signal that this is maybe a bottom, and then we saw this rally over the last week as well. So what's significant about this is it does seem to be setting up. The return above this low here is actually a reversal somewhat. It's not a new uptrend, but it's a reversal somewhat of this trend which started to the downside with low lows and low highs. And if we get, this is so strong that you would expect this to be followed by price, because momentum precedes price. So if we get this to correct and consolidate and we break, that's actually potentially the start of a third wave. So look out for this in the yen. I'm currently neutral, but I absolutely would not want to be shorting yen anymore given what we're seeing in the markets. And the final individual currency here, which I really like and I think is giving very good signal, is the CAD. We've been discussing that. I do think the CAD is going to come down to the lows, like the New Zealand, like the Aussie, even like the euro and the pound, but in a more recessionary environment and a risk-off environment, which we haven't yet seen kick in. In fact, we've been in kind of risk-on as this has been correcting. But now we've pulled back. We've got this A, looks like a B and a C, so it's just a correction. But what I really like about this is we've got this double top with an outside day. So technically speaking, okay, technicals don't trump the scorecards. The probabilities, the rolling probabilities of the markets are the most important. But the scorecard is giving a signal to look for CAD shorts. And when you overlay the technicals onto that, it also seems to be confirming that we could very easily see this selling off, and then you get your double top. And that also kickstarts to move back down to the lows. So very, very revealing, in my opinion, that this commodity currency, linked to crude oil, is now giving us this technical setup. At the same time, the scorecards are increasing the probability of CAD weakness heading into next week. Okay, so let's have a look at the markets this week that I'm looking to trade on my watch list, and the ones highlighted in gold are my 6th favorite. But you can see last week we were looking for a move into the 77 area in crude oil, and we did tag it, and as soon as we traded into there, that was your opportunity to book profits. You can see the sell-off. Going into this week, I think there are better markets than crude oil, but I do on balance still favor long positions. So any pullback in this market is first an opportunity to look for an intra-week breakout into the 78.50. Or if we pull all the way back to the 72 area, this is where you can also look for a short-term bounce and potential long opportunities or setups in crude oil. Next is the euro. Now last week, euro dollar, I did say to you in last week's video, I can either be long or do nothing. Selling euro dollar last week was not an option for me. Why? Because that's what the scorecards were telling us in terms of the probabilities, and the directional probability was that we were likely going to see euro dollar higher. Now, of course, the move in the dollar was so strong, that is not something that's easy to predict, unless, of course, you can expect them around those kind of news events. But generally speaking, that was a very unprecedented move in the dollar. So we traded right through the target zone last week, and that just shows you the strength of the rally and the sell-off we saw in the dollar last week. Coming into this week, I am either long or doing nothing in euro dollar. Any pullback in this area is viewed as an opportunity, once again, to look for a breakout intra-week into the 1.1350, Or if we pull back into the 1.150 area, this is an area you can also look for a buy the dip opportunity and for bullish setups for a short-term bounce in euro dollar. Next is US dollar franc. Really nice downtrend, huge momentum. I do think we're probably going to have to pull back next week, so perhaps the opportunity is for a short from the 87 area. But again, like the other markets here, I'm going to be looking for an intra-week breakdown into the 0.85250. Or if we pull back into the 87.25, this would be an area you can also look for potential short-term short opportunities for a near-term sell-off in US dollar franc. Next is New Zealand franc. This was highlighted as a market to look for shorts to the downside into the target zone. Look at this, we came right into the target zone. We did wick through it, but this marked the low pretty much for price last week. Coming into this week, I do favor shorts once again. We've already started to correct, so any continued pullback is simply viewed as an opportunity to look for breakouts. You can see over here, we started to break out down here and then we sold off into the target zone. So we're going to be looking for the same thing down towards the prior low, which sits right in this target area around the 0.5410. Or of course, if we just continue to pull back, because I can either be short New Zealand franc or do nothing, buying this is not an option for me next week. If we pull back into the 0.5560, this is another area you can actually look for a near-term short in New Zealand franc. Next is Aussie franc, highlighted as a good short opportunity in last week's video, and we came right into the target zone. This is where you should be looking to book profits. Okay, in euro dollar, we smashed through it, but that doesn't happen very often. Most of the time, this is where you will get the most out of your trades during the week. So we did trade into the target zone and we bounced last week. Coming into this week, any breakdown in this market is viewed as another opportunity, just as this pulled back and then we started to break down into the target zone. Any breakdown in this market is viewed as the opportunity to look for shorts into the 0.5820. And if we just pull back and we start to test the 0.5970 area, this is where you can start to look for a potential lower high and near-term shorts in Aussie franc. And the final franc pair is CAD franc. This was another market where the scorecards told us, look for shorts in this market last week. You can either be short or do nothing. You cannot go out and buy CAD franc. That was what the probabilities were saying last week. And we smashed through the target zone here again because of that sell-off we saw in the US dollar and of course brought volatility into the rest of the markets. Coming into this week, I'm looking for shorts once again, so any pullback in this area is viewed as the opportunity to look for bullish reversal to the downside into the 0.6450. And if we pull back into the let's say 660 just to be safe, this is an area you can start to look for a potential lower high in CAD franc and a short-term trading opportunity to the downside. So the first pound pair we're going to look at is pound dollar. Now remember, everything we've discussed in the dollar is in the bigger picture. We're looking at a weekly chart. We're looking over the course of the rest of this year. Going into next week, I can either be short dollars or I can do nothing. Buying US dollars next week is not an option for me. So any pullback in this market is viewed as an opportunity to look for bullish breakouts into the previous high or up to the 1.3250. Doesn't mean we do get here, but if you do get here, this is where you should consider booking profits on longs for that potential to try and get as much out of the trade next week as you can to avoid being on the wrong side of a reversal near term. If we do pull back into the 1.29250 reactively, you can also start to look for potential long opportunities in pound dollar. Next is pound New Zealand. This was a market highlighted to look for opportunities in last week's video to the upside, and look at this. We came in and we tested right into the profit taking area highlighted. That was your trade last week. If you could get involved in this somewhere along the way, that was your opportunity to book your profits on a longs. And look at the sell-off. You avoided this just by simply booking your profits at the max profit taking zone. Going into this week, I can either be long pound New Zealand or do nothing. Selling this market is not an option for me. And I don't really like the price action here too much because we tested the high and we sold off. But any continued pullback in this area is viewed as another opportunity to look for bullish breakouts like over here and up towards the 2.080. And what I think could be more likely next week is if we just continue to sell off and we test the 2.030 area, this more likely next week is maybe what happens and we get the opportunity for a short-term buy in pound New Zealand at these areas. Next is pound Aussie. This was a market highlighted to look for intra-week breakout to the upside, and look at this move right into the max profit taking zone and then immediately sold off. So again, this is where, once you test this area, the odds turn against you for further upside or downside in the week. So you need to consider booking your profits. Going into this week, I can either be long once again or do nothing. Selling this market's not an option. So if we do pull back and we do sell off, I would be looking for a bullish breakout into the 1.9400. That's intra-week. And if we test the 1.890 area, this is another place you can start to look for a near-term reversal, just as this sold off, but in the direction of the rolling probabilities. That's where I'd be looking for a potential buying opportunity in pound Aussie. And the final pound pair is pound CAD. This was a market highlighted to the upside last week, and the scorecard said you can either be long or do nothing. Selling this market last week was not an option in terms of the scorecards. And you can see it was a fantastic policy because this smashed right into the max profit taking zone here. It did sell off. You can see actually profits came in, but then we broke through at the end of the week. So another fantastic market from last week's video. Going into this week, any pullback is simply viewed as an opportunity to look for an intraday breakout or intra-week breakout into the 1.74750. And if we pull all the way back to the 1.17250, this is an area you can start to look for a potential bottom and short-term buy opportunities in pound CAD. Okay, so wrapping up the video with gold, silver, and Bitcoin. Of course, we do have that you can short dollars or do nothing next week, and I like the fact that the dollar is weak. So in terms of the precious metals, I do favor them to the long side, even if the dollar is going to be a bit rangy or corrective. Any pullback in gold is viewed as an opportunity to look for an intra-week breakout up towards the 19.90 area. And if we pull all the way back into the 1920 zone, this is going to be the area to start to look for a potential short-term bounce in gold. Next is silver. Huge rally in silver, and because of this, I actually prefer silver longs over gold longs next week. But this does need to correct, and I would imagine this is going to start to pull back early next week, and any pullback is viewed as an opportunity to look for a bullish breakout into the 2580. And if we pull all the way back to the 24 area, this is where you can look for a potential higher low and a near-term bounce in silver. And last but not least, we have Bitcoin. Now, Bitcoin is really choppy. I don't really like this too much as it is currently, but any pullback is viewed as an opportunity to look to buy this market. I would not look to be shorting Bitcoin currently. Any intra-week breakout into the 3240 area is what I'd be looking for. Or if we pull all the way back and retest the 2820 area, this is where you can expect a potential bounce near term in Bitcoin. So that is it from me for this week, guys. As always, I hope you enjoyed today's video, and if you did, why not consider joining us in the room each day where I go through these markets and the setups that I'm personally looking at with members on a daily basis for over 75 markets in different asset classes, including stocks, bonds, Forex, and commodities.